Hello, everybody. Welcome to our Let's Learn Futures webinar series brought to you by Bursa Malaysia Derivative. So, my name is Shen Chu. I'm the host for this webinar. Now, today our topic is trading the rhythm of the market. We have got a very exciting topic, and also we invited a very renowned veteran speaker in the industry, David Lowe, to share with us on this topic, trading the rhythm of the market. I think by the name suggests, I think the topic today is going to be, finding the rhythm of the market. Okay, if it's a bull trend, then we go towards the bull market. If it's a bear trend, then we go towards the bear market. So today's session is about finding and catching the rhythm so we can go in early of the trade. All right, so disclaimer before we proceed to this webinar, just want to share with you that whatever the speaker presented in this webinar is only for educational purpose. In no way that we give any buy call or sell call or any advice to you in or when it comes to longing or shorting any futures contract. So if you decide to do any of your financial decisions, you do it at your own risk. Okay, it's only for case study, educational purpose. Neither Bursa Malaysia, LiveChamp, nor the speaker or I are responsible for all your financial decisions. So for this, in this 2020, Bursa Malaysia has already have a whole series of webinars, futures webinar that are designed for you. And then this is probably the 6th or the 7th, and the whole year we have 22. And then the next session, next Thursday, we'll be talking about single stock futures. So almost every Thursday, we will have a futures webinar. So if you want to deepen your knowledge about futures, please reserve your Thursday evening for these Bursa Malaysia derivative webinars. Now, even though if you can't attend, you can also register anyway because the recording will be sent to you even if you can't make it. Okay, so reserve your Thursday evening for us. If you can participate online, then you can ask the speaker questions. All right, so allow me the honor to introduce our speaker today. So he is none other than David Lowe. Now, David is a trader and managing partner of Exmodius Trading Group PLT, which is a consultancy firm specializing in bespoke trading strategies and coaching for private and corporate clients in the equity commodity derivative markets. So he has 24 years of experience in Malaysia's listed derivatives industry. So before starting his own consultancy, David helmed leadership positions in the futures brokering divisions of major investment bank in Malaysia. He served as the president of the Malaysian Futures Brokers Association between 2018 and 2019. As a fervent believer in trader education, David has spoken in seminars and workshops to over 5,000 retail traders on trading Bursa Malaysia derivative, as well as the CME, SGX, and Hong Kong exchange markets. His work includes live market trading sessions and webinars. He has also been a trainer for licensed brokers for the continuing professional education program courses of SIDC. David has also participated as a panel speaker at international palm oil industry events such as POC 2019 and POTS India 2019. Okay, when I met David, I knew that I had to invite David to our webinar, and during the MCO period, I managed to convince him to do this topic for you. So without further ado, let me hand it over the session to you, David. I'm making you the presenter right now, David.
Thank you, Shane. Thank you for that fantastic and very, very long introduction. Thank you so much, and it's a pleasure and honor to join all of you together in this webinar this evening. First and foremost, a big thanks to the sponsors, Bursa Malaysia Derivatives, for having a whole host of these educational events for traders and investors. This is a very fantastic series of events, and I also want to thank all of you and also Bursa for the opportunity to share my knowledge and some of these trading ideas with you tonight. We have a lot to cover. Okay, I hope everything is good. The audio is going through good and clear to yourselves, and you can see the slides over here. Now, what are we going to learn? We have a lot of materials to cover, as I said today. Firstly, the title is very apt. We're talking about how to trade in rhythm with the market. Okay, so we want to see how we can always, when we are trading, how we can always be trading with the trend on the market. So in order to do that, we need to understand and trade the actual market structure. So we'll talk about what is actual market structure and how to know the actual market structure, right? Then we're going to learn how to recognize the futures market trend, okay? And we want to know it instantly, okay? And I'll share with you an idea which is simple to use, okay? And very quickly, you can use basically the skills that you already have naturally to be able to identify the market trend. And then the last part, we go in and set up the trade, how to go in. Whilst you already recognize the trend, how to go in, how to time your entries and your exits in tune with the markets. So these are the three main themes and topics that I will cover tonight with you. Okay, so we will be having a Q&A session at the end of the session. So please, at any time you have any questions, write down those questions. I think you have a link up at the to send in your questions. So send in your questions, and we will handle the questions at the end of the session. Okay. So basically, before we start, we want to ask ourselves, what is a market? You know, you see the picture there on. And this is a picture, an old picture of the New York stock market in the early days, right? And this, I think you still see some of these pictures in CNBC or Bloomberg when they broadcast the news. But what is basically a market? You know, basically we were talking about a crowd of people making decision and placing trades. That's what a market is. So in this sense, okay, let me scroll down. Okay, we have this guy here. Okay, this guy may not be very familiar, but he's actually a very, very famous stock market operator in the early 1900s. Okay, his name is Bernard Baruch. And one of the things that he said, he commented on the market. He's a very big market player. He made a lot of money in stock markets before the crash of 1929. He made a fortune. He got out of the market at the correct time. He made also a fortune in sugar. He made a fortune in rubber. So he's a big time player in the markets. And basically, to him, okay, whilst he's commenting those quotes that you see up there, okay, the stock market fluctuations are not events themselves, but human reactions to these events. So it's people and placing trades, whether buy or sell, reacting to world events, reacting to economic events, reacting to news, reacting to rumors, reacting to things that are happening around them. And once they react, then make decisions in the market, that is what actually makes a market. So in short, you know, the millions of individuals, men and women, okay, their emotions, okay. So basically, if you see right there, when you talk about people trading in the markets, they trade their hopes, they trade their fears, they trade their strengths, they trade their weaknesses, there's greed, and there's ideas. Everything is reflected in the market. So the market is a whole pool of people. Some of them very emotional, some hopefully not so emotional. These days, you have a lot of things like robots trading in the markets as well with no emotions. But this whole pot of all these people and even machines these days making decision is market that makes up the market. So markets as a whole is actually a reflection of human behavior, right? And this is interesting when you talk about human behavior in the markets. When you go in and everybody goes in and buy or sell, right? They go into what we call a group, okay. And in this study by this well, very difficult to pronounce his name, is Gustav Le Bon, okay, this treatise, he's talking about the crowd behavior, okay, studying how when people are in a crowd, how they act, okay, and basically he's come to a conclusion, and he says that when a person joins a crowd, okay, and you can say that when a person joins a market, he goes through a transformation, okay, and this is interesting, and you see whether this jives with you or not, or rhymes or rings a bell with you or not, right? You cease to operate as an individual, right? You lose yourself, you become part of the group, you don't make decisions so logically or rationally as you may used to, right? And you may be ceased to be guided by your will as well, and you tend to accept ideas superficially, especially ideas that support what you think or support the trade direction that you have, right? So this is in general how individuals, when they go into a crowd, okay, how they will react, okay. Now the thing of this, crowd psychology has a very big impact on the markets. Basically, the movement of the prices are a reflection of, basically, as we said in the last one slide, Bernard Baruch, it's a reflection of human behavior, right? And when it comes to crowds have a very interesting reaction. And what do crowds typically do best? What do crowds typically do best? Number one, crowds like to buy market tops. Okay, have you bought market tops before? Okay, I've done it quite a number of times myself. Okay, joining in the crowd, joining in into the fever, and actually buying at the highest prices in the markets. Okay, the other thing that the crowds like to do is they also typically sell the market bottoms, right? You hold a stock or you hold a particular position until you tak boleh tahan anymore, you can't stand it anymore, and then you sell right at the bottom, okay? And then once you start selling, the market starts to climb up and start to move up for you. So these are basically very, very typical crowd behavior, right? So what we want to do tonight is we want to learn how to read this crowd behavior, okay, and this crowd behavior is actually reflected in market prices. So we need to look at the market prices and recognize, okay, where is the trend, and we need to, as Shane was saying, how to get in on the trend on the early part and not get in at the end part of it, right? The last part of it, when everybody is selling or the smart money is selling, then you start to buy, right? Buying the market tops or selling the market bottoms in terms of futures, because futures you can buy or go short. Okay, so this webinar, of course, has some assumptions that you know a bit, because this is an intermediate webinar. You will need, you probably assume that you have some knowledge of futures. You already traded futures, you have some experience, maybe reading a chart and all that, right? So I'm going to assume that, because I won't have time to cover that those basics. So I'm going to really jump into it, right? So one of the ways to read the market or the crowd psychology is through this thing called the Elliott wave. And Ralph Nelson Elliott, who is the father of the Elliott wave theory, he was in the 1930s and 50s one of the very astute student of markets, and he observed that, studying through a lot of prices and charts and all that, he observed that the markets move in a very orderly, and it has a very repetitive wave-like patterns, which he called the Elliott wave. Okay, those of you who have studied technical analysis may be very familiar with this theory of Elliott wave. And in short, what the Elliott wave says is, in a bull market, it would have 5 waves up, and they call it the impulsive wave. The wave 1, as you can see over here, you can see my cursor move, a wave 1 up, followed by consolidation in wave 2, a wave 3, a very strong wave 3 up, and then you have a consolidation in wave 4, and then the last wave on wave 5, okay, and then followed by these corrective waves. So Elliott observed that markets, whether it's commodity markets or the stock markets, they all tend to move, and they all have this wave-like theory, right? We will not go into deep into Elliott wave today, because that is a very, very big topic by itself. But basically, it says that there is an order there. You need to be able to see that order, right? Okay, and later, after Elliott wave, during the 1980s and 90s, where computing power came in, the mainframes came in, they were able to calculate, and there were a lot of people who was studying this thing called modern chaos theory, and they were looking at natural systems, they were looking at nature, they're looking at rivers, and then they found out that in all these natural systems, okay, although they look very chaotic, it's like in nature, wow, this even a tree may look chaotic when it starts to grow from a seed up to such a big tree, but actually there's an order. There's an order of high degree. The tree grows, or the seed grows into a big tree. There is a law to it. Okay, the way that the rivers move, or the way that waves move in the sea, there is a high degree of order, right? So in terms of the whole chaotic system, if you know how to see the order, then you'll be able to move, okay, in rhythm with this order, right? So at the last bullet point, basically what it says is the markets itself also exhibit fractals, okay, because the nature of the market is crowd psychology, and by design, the human brain, or the human brains, and them reacting to those emotions, is also a fractal organization. So you can basically see emotions and of greed, fear, all those emotions reflected in prices in the markets, right? So this is the theory behind reading the Elliott wave and the fractal nature of markets. So in terms of reading the market trend, okay, actually reading the market trend is actually very simple, because we possess what we call the pattern recognition. We recognize patterns, okay, and in this chart you can see over here, instantly when you see this chart, you can tell in less than probably 5 seconds that this is an uptrend, right? And when you try to describe an uptrend, what is an uptrend? Although I put here H2, HL, basically it's higher high, higher lows. A bull market, okay, a bullish market, okay, exhibits this particular characteristic. It always have higher highs, okay, higher highs. So this H will go up higher and higher. And the lows, okay, the corresponding lows as well, because market don't just go up in a straight line, it moves in waves. So every time it comes down to a low, this low is higher than the previous low. Okay, so all the lows are higher than the previous lows, and all the highs are higher than the previous highs. Okay, so this is a characteristic of a bull trend or bull market. Okay, so instantly, as you can see, if you put up a chart, okay, you will be able to recognize this pattern, and you recognize this pattern because your eyes are trained, okay, since young. You're able to recognize this pattern because you see it in nature, you see it in the hills, you see it in your steps at home, okay, you see it in everywhere. You see this particular ascending type of wave-like structure, right? So let's go down and read what's a bear trend. Okay, now this is a bear trend. On the right you can see the diagram. Instantly you can recognize as well that this is a bear trend because the trend is going down, and this is also by virtue of your eyes pattern recognition. Okay, and to describe it, a bear trend is basically a trend where prices are moving, where the highs are getting lower and the lows are getting lower. Okay, so L2, LH is lower lows and lower highs. Okay, in all markets and in any time frame, whether it's commodity markets, equity markets, whether it's a monthly chart, weekly chart, daily chart, or even minute chart, or even you want to go in a 1 minute chart, okay, it will exhibit this waves. Okay, why does it exhibit these kind of waves in every time frame? Okay, even if you throw in a very weird time frame on a 3.5 minute chart, okay, it will also exhibit this, because these are what we call in modern chaos theory, these are all fractal nature and the wave-like nature of the markets. It's like a law, right? It's like a law of gravity in terms of the prices, how they move. This is like the law. All right, so let's go through. We have a bull market trend, you can recognize that. You have a bear market trend, you can also recognize that. Now we have the other part. Okay, this is the third way the market can move. It moves sideways. Okay, this is what we call a consolidation trend, where the highs are quite predefined. There's like a ceiling to it, and the lows, there is like a floor to it. Okay, and markets tend to trade in this range a lot of the time as well. Market stays in consolidation for quite a big percentage of the time, right? And these are of course markets that are not favored by traders because they find it very difficult to trade, right? Because there's no trend. Basically, it's moving nowhere. It's just moving between these two price levels, the high and the low, right? And if you are a trend trader, this side markets really, that's where a lot of traders actually have what we call the equity drawdowns. Okay, they lose money in this kind of structure because every time they try to buy, looking for a trend, it comes back down, right? So you look at here, maybe, oh, it's going to go up, but then once they buy, it comes down. And over here, you think, you can sell, but when you sell, it goes up. So a lot of traders lose money over here. So we also need to be able to recognize how a sideways market move, right? And visually, of course, it's quite easy for you to see in the last 3 slides how markets move. Okay, so that is the law, or that is the nature of the market trend. So let me take you to this very important slide. Okay, of all the slides in this particular deck of slides, this is a very important part because this is where you decode how a market turns, right? Because it's very easy, as you saw in the last couple of slides, how to recognize an uptrend and how to recognize a downtrend. But how do you recognize the reversal, right? So I have circled over here, and you can see in the green region over here. Okay, now this is on the left side of this chart, you have a downtrend, right? You have the lower highs, the highs are getting lower. You can see the highs are getting lower, and you have also the lower lows, right? The lows are getting lower, lower, and lower. Now, so this is this particular side of the trend is, of course, the let me see where can I draw something. Okay, let me draw something, right? So this part is the the bear trend. Okay, so how does the bear trend turn, right? So the bear trend turns here. Okay, let me erase the drawings. Okay, now this is where it turns. The prices make a new low, okay, followed by a lower high. Okay, as in the last few waves, it makes a low, okay, and then it makes a high, and then it comes down. Okay, as it's going down, it does not create a new low. Okay, for the trend to go down further, it needs to have a lower low. That's the nature of a bear market, and that's the law of the bear market. It needs to make a lower low, but it doesn't. It fails to create a new low. Okay, and then okay, this is very important, and then it proceeds to break above the recent high. Okay, this a very important point is here. Okay, this part here, it breaks, it goes up and breaches this particular high. Okay, and that is the code, that is the move which a market turns from a downtrend to an uptrend. So the reversal of the downtrend, you need to be able to what do you call that, burn this particular picture in your mind. Okay, because this is the most important pattern to recognize. Okay, we will go through all the some examples so that you can see it clearly, right? So again, if you have any questions, please put your questions at the end of the session and we will answer all of them. Okay, but I'm going to go through another example with you. Okay, so same thing, reversal of a downtrend. Let's say, for example, you are short. Okay, at that time, you were, okay, maybe, I don't know, you were in end of this year, maybe you're trading palm oil and you were actually, the market was coming down. So every time the market goes up, the rally, you sell, rally, you sell, rally, you sell. Okay, so there will become a time when the market turns. Okay, so over here, it makes a lower high, okay, you see over here, then it comes down, but fails to make a lower low, right? As we said, fails to make a lower low, then takes this high out. It's time to do what we call a stop and reverse buy. Okay, in this situation, when it breaks through this price range, what we do is, if we don't have a position, we will initiate a long position, or if you are short, let's say if you are short, you will take your profits and you go long. Okay, that's called a stop and reverse. Okay, we will go through some examples with you afterwards. Okay, and here is some examples of a reversal of a downtrend. So in early this year, there was this strong downtrend. Okay, up till this part over here. Okay, this is a line chart. So I drew a line chart for you so that it's easier for you to see the lower low and lower highs. So obviously on the left side, this you see all the lower lows, lower highs, lower lows, lower highs, and come down here, it makes a lower low, lower high, and then this particular move down, it doesn't make a new low. Okay, every time it does that, okay, you need to be very aware what the market is doing. Okay, this is the key here. This is the key to read the reversal of the market trend, right? So it goes here and then it takes out this top. It takes out this top over here, right? You see this top over here? It takes out this top. Let me see where I can draw that. Okay, it takes out this top over here. Okay, and this is where you initiate long positions. This is where the market has turned. Okay, and on the way up, of course, there are many of these buy points. Okay, right over here, right over here, right over here, even right over here as well, right, and right over here as well. Right. So once you train your eyes to see these reversals and also the continuation pattern of this particular trend, you will know how to go into the market either to reverse or to continue to pile on to your positions. Right. Okay, let me take the drawings out. Okay, let's move to another example. This is FKLI. This is a daily chart as well. Okay, so this is the COVID moved down, okay, and then it exhibited this particular move. Okay, so this is in mid of March. Okay, mid of March. Okay, it does this. It was a lower low, lower high, lower low, lower high, lower low, lower high, lower low, lower high, come down. No more lower low. Okay, so the bull song has ended. Sorry, the bear song has ended. The bear song always is a lower low, lower high, lower low, lower high, lower, right? No more lower low. When the song changes, okay, when when the DJ plays a different song or the market plays a different song, you need to be in rhythm with it. Okay, you need to change your step. Is the music has changed, so you need to dance to a different tune. Okay, so this particular move in this circle here is initiated a new song. Okay, and this song is a bull song. Okay, so to be in rhythm with the markets, you need to be dancing to the bull song. Okay, so let me draw it again so that it's clearer for you. Okay, right over here, sorry, yeah, right over here. Okay, right over here, sorry, my drawing control of the mouse bad. Okay, right over here, when it breaks out, then it's gone to a bull market, right? And if you go to the even in charts on the Dow Jones or any chart at all on the equity market, you would see this particular one, right? And this is happening in the Malaysian market as well, right? So we will go into detail later on all these charts. So let me remove the drawings. Okay. Okay, let's move on. Okay, now how do we recognize up move that has ended? A bull move that has ended, a bullish trend that's ended or reverse. Okay, so in a bull trend, as we said, we will have this song playing. You will have the higher high, higher low, higher high, higher low, higher high, higher low. If the song of the bull is going to continue, it needs to make a new high. But look over here, it doesn't make a new high, right? These prices don't make a new high, but it comes down to break this low, okay? A failure to create new highs and then proceeds to break the recent low, okay, over here, okay? So once it does that, the bull has changed the song, the DJ has changed the record, it's no longer playing a bull song, it's playing a bear song. Okay, so let's look at the next chart. Okay, this is what happens when it does that. Okay, when it breaks this particular low over here, okay, it's time to take profit. Okay, so recently, of course, a lot of you hopefully you've made some money from the equity markets as well. Besides the futures, you can see that over here, if you go on to the charts of your equity charts as well, you can also see these types of move and when to take profit. Okay, so even if you're trading FKLI, you were long from mid March onwards, the trend was up. When do you take profit? Right, those questions can be answered by just looking at this particular move over here. Right, so you see over here at this particular point, this particular line, when it breaks this price, you should lock in your profits, and then if you can short the market, as in futures, you go short the market. All right, I hope that that is clear. We will have more charts to show you. Okay, this is a case study on the palm oil markets, and this is a daily chart. Okay, this is in the start of 2020. The market actually last year was on an uptrend, a very nice uptrend, and then you see the trend, the higher high, higher lows, higher high, higher lows. Okay, the song of the bull is playing, higher high, higher lows, and then it fails to make a new high. It fails to play the bull song. The bull song has changed. Now it takes out this low over here. Okay, and then it plays the bear song. Okay, it plays the lower low, lower highs, lower low, lower highs, and all started over here at this particular point. Okay, so if you were trading palm oil last year and you're holding on to this fantastic trend, okay, we took it up to um, uh, 3,000 over, okay, and here is the time to take profits and then to go short, okay, and you would have a spectacular move down during that particular time when we had this coronavirus situation, right? So this is a reversal of an uptrend. Okay, and if you go to any charts, any commodity charts, you will see this particular move being played out during the reversals. Okay, so this I need to emphasize, this is a very important pattern to burn inside your memory. All right. Okay, so those are the basics of seeing how waves move. Okay, so now is how do we trade the waves? Okay, so once you recognize the trends, okay, and you easily could see in those examples the trends, the uptrends and the downtrends, and then also that particular move on the reversal. Now, honestly, it will take a bit of time for you to get used to seeing that signal. So it takes a bit of practice. I'd say if you diligently practice and look over charts over the next, say, 2 weeks, okay, and recognize the charts and take out a chart and draw that particular and circle those reversals, okay, in 2 weeks or less than 4 weeks, I would say, if you diligently do it, that particular pattern will be burned into your mind, okay, and that particular pattern is very useful and is going to be very profitable if you can see that particular move. Okay, now we are going to go into a bit more detail. Okay, having read the trend, we're going to identify where to do the buy and the sell, the entries and the exits. Okay, so I'm going to talk about this ABC entry and exit system. Okay, basically it's a trading system, and it came from this thing about trying to simplify my trading. Okay, when I first started trading, I had a lot of indicators. I had a lot of technical indicators on my charts. My charts looks absolutely very complex and complicated. And I started to slowly reduce and remove all those unnecessary things and come down to this, which I've learned from quite a number of mentors and gurus. Okay, and this comes down to basically price action really. Okay, because basically when you're trading the truth on the market or you're trading the actual reality of the market, you're actually trading the price action. Okay, so technical indicators are helpful. Okay, but if you trade the price pattern direct, that's as pure as you can get. Right, so this ABC entry system and existing is a very simple system to identify a trade setup. Okay, it doesn't require any sophisticated technical analysis software, but you need a chart. Okay, and if you are trading, most brokers would have free charting software for you these days. Okay, if not, I will recommend you to go into the internet. There are some providers like TradingView, which provide very good charting software and a very reasonable price, and you can get live prices for Bursa Malaysia derivatives as well. So I think, if I'm not mistaken, the price for the Bursa Malaysia derivatives live data and charts is only $1 a month. Okay, so that's a very useful software to use. Okay, if you don't have a software, I would recommend that. I use it myself. Okay, and I'm not related to TradingView, but that's a tool that I use myself. Now, this method is very easy to master, and by using this method, you are basically predominantly trading with the prevailing market trend. Okay, that means that you are in the same rhythm as the market, you are in the same trend as in the market. Okay, you can also catch early trend reversals. Okay, when people don't recognize it, if you don't see those reversals that we spoke about in the last couple of slides, and a lot of people don't see it. Okay, so if you train yourself to see those reversals, you'll be able to catch those early trend reversals. And this particular ABC buy sell technique is very versatile. It can be applied to all markets and all time frames. Okay, because as we say, this wave formations, or this wave structure of the market, it prevails in all time frames and in all markets. Okay, if it is a truly liquid market, I must add. Okay, so if you are adventurous and you're going to try it on some very illiquid type of markets, it may not work. Okay, it needs to have a market that's got players in it, buyers and sellers, and very liquid markets. Right, so that's my only caveat for this system. So let's get into it. Okay, so how do we recognize an ABC trade signal to buy? Okay, and this, if you look very familiar to you, okay, later I'll show you why. Okay, we are looking for a buy signal. Okay, so it's very likely that the market is on a downtrend. Okay, and we're looking for a good price level to buy. Okay, so as you can see on the left part of this chart, okay, you have charts of the prices coming down. These are bar charts coming down over here, and then it makes a high. Okay, it makes a low here at A, then goes up and make a high at B. All right, and then it comes down to make a low, but this low doesn't break A. Okay, this low doesn't create a new low. Okay, so is that familiar? Right? This sounds like the reversal that we're looking for, right? It's ABC, right? So if market does this particular setup, and we call this the ABC setup, okay, you have a low followed by a high and followed by a next low which doesn't break the A low, and then goes up and break the B, okay? And this particular setup, if it breaks, if prices break through B plus one, that means it trades above B plus one, right? So for example, if you are trading the FKLI, and let's say for example this is 1.6, if B is 1600, and then now market has moved up to 1601 or 1602 or 1603, it's triggered a buy signal, right? So you will buy when it has triggered this. Okay, and on the right side you can see the same formation, but this is with a bit more bars. Okay, it's the same formation. You have an A, and then you have a B high, and then followed by market retracing down. But when it retraces down, it doesn't create a new low, right? So A, B, C. Once you have this formation, you will draw a line across this particular structure, or this particular price here, the B price, and you look at it, what is the price? Okay, and you will buy if prices trade above this price. So it has confirmed if it trades through this particular price. Okay, and for those of you who are trading, who are familiar with the orders that you can put into the future system, you basically can put a buy stop order above B. Okay, so if B is say 1600, you can put an order like buy a stop order at 1602 when the market breaks out. Right, that's how you would do an actual order using this particular signal. Okay, so let's go in and have a look a bit more detail. Okay, this is when I put the lines in. I draw in the line so that This has become something that you're very familiar. You've seen it in the last couple of slides. Um, okay, the A, I've drawn this chart here. So this is familiar, right? You have a low, you have a high, you have a low that does not break the low and then goes up and break the B, right? This is the reversal signal that you saw in the previous slides we have just done just now, right? Just to give you a visual view of how it looks like. So same thing, you buy B plus 1 above when the markets break through this particular price range. Okay, what about a sell? Okay, what about a sell? Okay, a market is going up, okay, and you're looking to probably take some profit. Okay, where do I take a profit on the chart? Okay, or where do I have a new sell signal? I want to sell. Okay, but where is my sell signal? So markets are moving up. Okay, it forms a high at A, comes down to form B. When it comes and form B is actually quite normal because before this it probably have done that many times. Okay, and then it goes up, market goes up to C, okay, and then comes down. That means C doesn't break A, it does not go above A, right? And as you are familiar, if you had a bull song, okay, the bull to continue to go up higher, you will need to make a new high, but this time it doesn't make a new high, it comes down and break B, right? And this is familiar as well. Just now we spoke about it. Anything when the market trades below B minus 1. So if B is 1600, and if the market, let's say for example for FKLI, the futures on the index, if it trades 1599, okay, one tick or two ticks below B, which is 1600, then you will sell. Yes, confirm a sell signal, right? So in terms of putting in an order, okay, even before it comes to this particular point, let's say for example, it has made the ABC setup, okay, you can around this region put a sell stop order at B minus 1, okay, so you can key in an order, or you can give your broker an order to sell stop this particular contract, for example FKLI at say 1599 or 1598 stop. Okay, so when it triggers, when it trades through that, then you are in the trade. Right, so that's how you put an order for the ABC sell signal. Okay, and to make it easier for you to see, this is I've drawn in the wave structure for you so that you can see how it looks like, so that it's familiar to you. Makes a new high, come down, makes a new low, goes up, doesn't make new highs, come and breaks the new low, right? And then markets continue to do this. So this is the ABC setup for a sell. All right. I'm going to go through some examples so that you can understand and see it more clearly. Okay, this is the rules of the ABC. The words here are even more difficult. The concepts are simple, but this just to sum it up in words, right? So the buy signal is basically you initiate a buy when prices trade above B. Okay, after the C low, the C, which is the low, okay, a bar is formed, and if C breaches A downwards, this is a important thing to note. If C breaches A downwards, then the buy signal is cancelled. The B is cancelled. Okay, because when C breaches A low, then it's making new lows, then you won't go and buy, because making new lows is the trend is still continuing to go down on a bad trend, right? So on a sell, you initiate a sell when prices trade below B after the C high is formed. And if C breaches A, okay, if C breaches A, then the sell signal at B is cancelled, because if C breaks the A high, then it's going for a new high. So that is a continuation of a bull trend, and you don't sell into a bull trend. All right, we'll look at examples of how to do that in more charts later. But basically, this is in words. Words are less easy to comprehend. Picture speaks better than 1,000 words. Okay, but I want you to know the more bars or time between the B and C, and then if there's a subsequent breakout of the B, the better the potential the trade is. Okay, basically what it says that between the B and C, if or even the A to C's, there are a lot of people trading in particular range, and that particular range could actually be a sideways trend. And when it breaks out, a real breakout of a sideways band or a sideways market, you see a very big push or a very big potential on the trade, right? And just to remind you that the ABC setups can be identified at any time frame. Okay, be it a 5-minute chart, hourly chart, a daily chart, a monthly, or even a weekly charts, right? So if you are already in a position, the ABC long and short signals can actually be used for squaring positions. Let's say, for example, you are now in a position long, what do you call that, FKLI, and if there's a take profit signal or a sell signal, you can use that to take profits. And then if you want to go with the new trend, then you stop and reverse. Right? So this is basically the rules of the ABC in words. Okay. Now here I've taken up a chart. This is the FCPO 60-minute chart, right? And I've identified some of the ABCs for you, just to make it easier for your eyes to recognize. So right here, you can see there's an A here, and there's a B here, and the C over here, and this C doesn't break the A. Okay. Coincidentally, this particular ABC, it formed a sideways channel. Okay, and sometimes and in fact most times, sometimes the market just don't change from a downtrend to a uptrend immediately. Not all markets change in like a V-shaped kind of formation. It tends to come down and form this sideways move. It's trying to find a position for itself, so it consolidates. Okay, the bulls and the bears take a rest, and then there's this battle between these B and C levels. Okay, that's why it's a sideways trend, and then a breakout. Okay, so for the black ABCs, the breakout actually happened quite a number of bars away, right? And when it actually broke out of this particular range, and we said that just now, if it breaks out of a longer range, if there's more bars in between the B and C's and breaks out, the trend tend to be quite fast. As you can see over here, this particular move of the hourly chart, it actually had quite a strong acceleration after the breakout. Okay, so we have multiple ABC cells over here. You have another A, B, and C formation, which it broke out over here. So over this particular region, you can actually have bought either these two regions over here, which the price are quite near to each other. Okay, then you have this long particular acceleration up. Okay, and then it has a ABC continuation signal. Okay, so it comes back as all waves. When it moves up, it also comes back, and it gives you another chance to buy into the rally. Okay, so it comes here, you have another A, and you have a B, and you have a C over here, and then another breakout and a confirmed breakout of the extension of this particular trend. Right, so this is on the FCPO 60 minutes charts. I trade 60 minutes charts a lot. That's one of my favorite time frames. For 60-minute charts, basically the trends for 60-minute charts, when it breaks out of this ABC, it will tend to last for about 20 bars. So a 60-minute chart, you can expect to probably hold that particular trend for overnight or 1 or 2 days. Right, now, if you're trading the day trading, then you will go to probably a lower chart, like a 15 minutes charts or 10 minutes charts. That's what I do. If I trade day trading, then I'll go into 10 minutes charts or 15-minute charts. Some of my fellow traders, they go into 5-minute charts as well. Right. Of course, the lower the time frame it goes, there'll be a lot more noise. There'll be a lot of trades that doesn't what do you call that, develop so well, right? So if you're going to lower and lower time frames, you have to be prepared for that as a trader, right? So that's why 60 minutes is a good balance for me, okay, for 1-2 day trades. So that's why the 60-minute chart is my favorite. So let's look at another chart to see. Okay, this is a sell chart on the FCPO 60 minutes as well. Same thing. Okay, I've drawn out the ABCs. You see the black ABCs over here, a high followed by a B low, followed by a C high, and C doesn't break A. Okay, and then it comes and break over here. So you sell at this particular price. Okay, which incidentally later you also form another red ABC setup over here, ABC, and you have another sell signal over here. Okay. Now over here, of course, I didn't put in the buy signals. You have ABC buys over here as well, and then another ABC sell over here. Okay, another ABC sell over here. So these are the illustration of the sell signals of the ABC setup. Okay, so I hope that's clear. If you're not clear, you can ask questions afterwards. Please type in your questions and we'll take the questions at the Q&A. Meanwhile, I'm going to take you out of these slides and we are going to go into the latest charts, because the charts we saw just now I prepared a week or two before. So let's go into live charts. Okay, of course, Bursa Malaysia markets are closed at this particular moment, but we'll look at the latest charts over here. Okay, so let's look at this. Okay, let's see, what chart is this? This is the FKLI daily chart. Okay, so let's do some practice and get your eyes acclimatized to what we have talked this session. Okay, so let's look at this. Now, if I just put on a line chart for you, okay, just for you to recognize the waves. Okay, so you can easily see over here the trend of the market, and these are charts of the closing points of the daily chart of the index futures, Malaysian index futures, FKLI. You can see that this is very obvious. This is on uptrend, and that it had a downtrend over here, okay, and then another uptrend over here, and then it came sideways. The market was sideways for quite some time. In fact, from middle of first week of July until just a couple of days back, still technically in a sideways market, but there has been some signals that you need to watch out. It could be a sell signal over here that we'll have a look at that. Okay, let me get out of this wave chart, line chart. Let's go into the, yeah. Okay, so I've taken a point over here and you can see some of the formations over here. The latest ABC over here, there's some new ABCs here which I show you. Okay, but let's look at this top over here. There's an A top followed by a B bottom, and the market goes up to C, and then it triggers a sell. It actually triggered a sell over here. Let me take this at 1545.5. That is the B. Okay, so if it traded this low was actually 1541. Okay, so 45 was broken, and there's a sell signal over here. So in terms of the ABC setup, currently you have a for this particular signal is a sell. Okay, but if you look a bit closer, hey, you can say I also see a particular formation over here which possibly, okay, let me put it over here so that you can see it. Okay, there's a ABC buy as well if it breaks over here, right over here, right, which is 1585.5. Okay, so if you are short the market, okay, and you also know that at 1585.5 it breaks through that, so say for example it trades to 1586, then if you are short, then you need to go long, or you need to cut your losses on the short trade just now, which we saw. If you took a short trade here, then this is where possibly you will need to get out of the position. Okay, you may even get out of the position. You may say now, okay, this is really getting in deep into this chart. You can even identify, if you're if very familiar, you can actually identify the ABC over here. Okay, so in that case, you probably again will be square already for this particular signal. Okay, so where is the next ABC sale? Okay, let's go to another chart. Okay, yeah, I hope that was clear for you. Let's go into palm oil. Okay, let's go into palm oil. Or okay, let's continue with FKLI. Let's go into the hourly chart. Okay, this now was the daily chart. Okay, so now for the hourly chart. Okay, this is interesting. Let's go back to the latest signal. What is the latest signal? Okay, so the latest signal, you have a A over here, and you have a B over here, and you have a C over here. Okay, and then the trigger is right over here. Okay, so if you're trading hourly charts, okay, you will be short. Okay, and you will be short, and it was triggered when? It was triggered yesterday, 24th of August. Okay, when it broke this low. Okay, so that was 1571. So if it broke through, went below to 1570, you'll be short. And if you did that trade, Okay, let's open it up for you, the ABC. Okay, ABC, a short over here, and you can see from the 71 levels today, it came to a low of 56. So that's basically if you shorted at 1570, which is one tick below the B, and then up to here is 1556. You basically have a in your pocket at one time. Today it closed at what price? It closed at 1557. Okay, so 1557 to 171. Okay, so 170 if you shorted over there. So you have quite some decent profit. Okay, and what is saying that potentially for the next couple of days, the trend is likely to be lower for the index. Okay, so if you're trading ABC, you'll be short the hourly chart. Okay, let's go into even a smaller time frame. Okay, and let's identify some ABCs on the 15 minutes charts. Okay, you can basically also see the same ABCs on the 15 minutes charts. Okay, do we have an earlier ABC? Yes, possibly over here, an A, a B, but the levels will be probably the same as well. Okay, so the sell levels will be probably, you're looking at almost the same levels. Okay, 1570, so it's about the same. Right? Of course, you can go in further if you're day trading. Okay, if you're day trading, let's say for example you're trading on 24th. Okay, so we'll ignore all those. Let's bring the ABC down. Okay, so let's go to 15 minutes chart. Let's say you're day trading 24th. Okay, 24th. So this is your time frame. You come in on 24th. We look for signals. Okay, 24th. I have A here. I have B here. Okay. Okay. The reason why I can put the ABC so fast is because my eyes are so used to seeing this. So that's why I'm a bit fast. Okay. And so it comes with a bit of practice. So after you practice seeing it, okay, you see ABC, the sell is over here. Would you have been able to make some profit? Not so much. Okay. You probably shorted at 1572, and then at most 68.5. So 24 wasn't that great. Okay. You came up probably profitable if you went out of the day, because at the end of the day it moved back up to close at this price 71. So you may just break even or something. But then let's say for example you come in again on the next day. Actually, for FKLI, I prefer to trade hourly charts because 15 minutes sometimes the range doesn't have enough meat for me. Okay, but this just since we're here, let's go and just some look at this ABC's sell signals. Okay, so you have A, you have a B, you have a C over here. Okay, and then you have a breakout over here. Right here. So that's 1566. And if you have shorted 1566, today would have been a better trading day, right? You probably have 10 points on the FKLI, which is 500 ringgit, right? 10 points times 50. So today is a better trading for 15 minutes. But personally, for me, when I trade the FKLI, my time frame is hourly. Okay, because the FKLI tends to be less volatile compared to the palm oil. So let's jump into palm oil and have a look. Okay, palm oil, my favorite contract. Let's look at hourly. Okay, hourly today we have a nice signal. Okay, actually it was triggered yesterday. Okay, we have an A, B, and C over here, and this is to sell the market at 2668 and below, right? So if it was triggered over here, you'll be short. Market, of course, one of the things about the palm oil market is it tends to have these gaps, the openings, the lunch time. So it's a bit aggravating, but then the trends are still quite nice actually. Using the ABCs, yes, you'll still be quite all right, right? So over here, you have one sell signal below the 2668. That means if 2667, you shorted, so you have shorted over here. Depends on your stop. Okay, you may or may not be triggered on your stop here depending on where you put it, but if you put a stop at C, which is 2 700, and one tick above that you will not be stopped out, and you have continued to hold it. Today it closed at the price of 2614. So this is a very decent trade. Okay, this is a 2614. It's about 50 over points on the Palmer. Okay, and expected you will still, because you're trading the hourly charts, you'll probably be holding an overnight position for this particular signal. Okay, so let's look at the daily chart. Let's see whether the daily chart shows any particular reversal trends. Okay, as you can see, for the daily chart, it's been trading in a range actually. Okay, somewhat of a range over here. It's been trading in a range. So now this particular point is very, very important. If you look at this particular chart, then the ABCs will be over here. These are the critical points to look out for in the daily chart. Okay, you have a ABC here. This particular price point is very important on the daily chart. If it breaks this particular point, then it basically says that you have a sell signal on the daily chart, which is 2568 and below. Right. So by looking at the ABCs and looking at trends, you can basically, before the market happens. Now, you can see here the ABC is formed over here. The B has not broken out yet, but you know already if it breaks below the 2568 price, the market is potentially on this particular trade is going to be going down. Okay, so it tells you which price to trigger a buy or sell even before the market has done it, right? It basically tells you where is the setup, right? So let's go in and look at the hourly setup. Okay, as we said just now, you had the ABCs over here. Okay, what if you are trading intraday? Okay, of course, for Palmer, intraday is a fantastic contract to trade intraday. So if you came in today and you saw, oh right, so we have a particular okay, let me get some of the ABCs down first. You will have an A over here, a B over here, okay, and a C over here, okay, and you have shorted around the 2655 levels. Okay, so we have some decent profits. Day trading, you probably could have gotten about a 40-point move over here. Okay. So these are some of the examples, and in multiple time frames, you will see all this. Okay, this is 15 minutes. Yeah, so this CI, and this happens also. I'm just gonna take a it happens in all other markets, including the equity markets as well. So if we just quickly take a snapshot of this particular stock, Supermax, on a daily basis, you have the ABCs over here, ABCs. So if you are, this is a quite important point, the 1594 level, it breaks this, then it's going to be a bit of a headache. You know, the trend, a lot of profit taking will come in. But if you see all these formations, the ABC buys are all here for you to basically be able to buy around the 935 levels or even the 809 levels. Okay, more further buy signals over here, and then ABC over here actually you will have locked in some profits over here. So in all types of markets, okay, whether it's stocks, futures, commodities, because it's a law of the charts or the waves, it will exhibit these prices. All right, so yeah, so let's get back to the slides. I think we've come to the Q&A session, but before that, let me wrap up. Okay, so the steps to master the ABC signals. Okay, you need to train your eyes, because this system is a pattern recognition, and you're using your eyes to pattern recognize these ABC signals, right? So you need to, number one, first train your eyes to decode the reversals. Okay, where the higher highs become the change in the tune of the market from bear to bull and from bull to bear. Okay, practice and practice. 2 weeks minimum. I think if you're diligently practicing it for 4 weeks, you will see that particular pattern already in your head. Make sure it is, the pattern recognition is embedded in your mind. Okay, And once you have it, okay, you should be able to quickly identify the trend and know the entry and exit points of the futures or any market. And I guarantee you, once you know and can see this in less than 10 seconds, you'll be able to know where are all the buy and sell signals. Okay. Now, I this is a photograph actually of my bathroom. This is a mirror in my bathroom. That's my bathroom door actually. This is a mirror inside, and this is my bathroom, my shower. So my wife retired, and she said, "I want to learn trading." So the same thing. Every time someone wants to learn trading, I'll teach them. And I drew this on the mirror of my bathroom. So every time she brushes her teeth, she'll know how to see where the buy and sell signals are. You could do that. Okay, you can put a chart in your study room or in your office by the side. Don't let the boss see it, okay? But you can study and embed that particular pattern in your mind. Okay, so we move down now to the question and answer. I will pass back to Shane to moderate the question and answer session. Shane, back to you.
Thank you so much, David, for sharing with us very simple but yet very powerful trading strategies, which is a ABC trade setup. All right, so now let us, if you have any questions to ask our speaker today, David, please kindly write your question in the Q&A box in a full sentence so we'll be able to understand it. All right, so I have over 10 questions on my screen right now.
Fantastic.
So why don't we start with the question, right? What is the benefit of trading futures over equities?
Okay, good question. Okay, they are definitely very a different way of trading. Number one, futures is what we call leverage trading. Okay, and if you're trading equity, the main difference is if you have tried share margin finance, then you have tried a bit of leverage. Okay, so share margin finance basically gives you 2x leverage. So if 100,000, you can buy a value of up to 200,000 worth of shares, right? For futures, like let's say for example, if you're talking about the index futures, the FKLI, the FKLI now, say for example, just to take an easy number, 1600, let's say for example, this index at 1600. The value of the index is actually 1600 times 50, okay? So that is the value of the index. And how much to trade the particular index, you're needing like something like 4,000 ringgit to trade that. So you have a leverage of that's very powerful, okay? And let's say for example, if you're trading palm oil, okay, every contract of palm oil is 25 metric tons. So if the palm oil now is, say for example, say an easy figure, say 2,000 ringgit per metric ton, so you're trading a $50,000 ringgit contract, and your margins are like 5,000 ringgit. So there's 10 times leverage. And what that means is 10 times leverage. What it means that if the market goes up by 1%, say on palm oil, your account or your equity will go up by 10%. So if market goes up by 10%, then your equity or your margin or what you put in on the deposits will go up by 100%. So you multiply your returns by the multiples of the leverage that you have. Okay, but of course leverage is a double-edged sword, so you need also to be careful because it can work both ways. In terms of trading leverage products like futures, you need to be able to know how to manage your leverage. And we have a few sessions coming up in session 2, 3, and 4. We'll talk about how to manage your risk as well, right? The other thing about trading futures is you basically, if you trade equity markets, it's what we call a one-way market. That means you make money only if the market is on a bull trend, okay? But in futures, you can trade short as well. So if you see that the FKLI just now, as we saw on the 15 or hourly chart, it was on a downtrend. So we can actually benefit from downtrends as well. So it gives you a lot of flexibility. Okay, so we are not saying that futures is inherently more a better product than equities. We're saying that you should use both. Okay, there is a time and place for each of these products. If the equity markets are getting very, very bullish, it's a good market to be in. You can also trade a bull market on the index, overall index, or you can trade. Let's say, for example, there's no more action in the equities, and equities are a bit slow. Then you can look at other products like trading palm oil or trading the FKLI on the short side as well. So it gives you a lot more flexibility, right? But the main advantages of trading futures is basically the ability to trade bear markets and bull markets, and also the ability to have leverage. So be able to use less capital to trade a larger size exposure, right? Those are the key advantages of futures as compared to equities. I hope that answers the question.
Definitely. Okay, fantastic answer to that question. So the next question is by Rosalind. For your ABC strategy, is it best that we use line chart or candlestick? But if we use candlestick, do we include the shadow or just the body?
Fantastic question, Rosalind. Okay, when I trade the ABCs, you saw that when I put up the ABC signals, I use the candle charts because the shadows and the highs and the lows are important for the ABC setups. So the ABCs, all the A's and B's and the C's are either the highs or the lows of the individual bars. So yes, you take in the shadow as well. The line chart is a good way, because the line chart, that particular line chart which I put up, is actually the lines of the corresponding closes of that particular time frame. So it gives you a very quick way to grasp the trend. Some people are not used to seeing all those highs and lows, all those candlestick. But if your eyes are already very accustomed to bar charts or candlestick chart, that's fine. Then you don't have to worry about the line chart on the close. So I use the candlestick charts or the bar charts with the high and lows, and you have to take in, if you're looking at candlesticks, you have to take in the shadows as well. I hope that answers the question for you, Rosalind.
Okay, so that includes the shadow.
Yes.
The next question is by Nicholas. How do we avoid being trapped by a false breakout with this method?
Okay. I wish there's an easy answer to that. Okay, I also get caught in this what do you call that, this false breakout, and that is the dilemma of trading breakout systems. Okay, but it's one of those things, because that is why even for a very reliable market structure, look, because market tends not to only it tends to go into what do you call that, consolidation patterns. That's where when you trade the breakout, it doesn't take off, right? So if you want to avoid doing that, is a subject that we need to go deeper in. You will need to study some of the things like which phase of the market is that particular trend in, especially in the Elliott wave, right? So you want to avoid the consolidation phases like in wave 2 or wave 4. Okay, you want to trade the wave 1s, the beginning of the trend, or the wave 3, which is a very aggressive part of the up move or down move, depends on the wave 3, and then you want to trade the 5th wave of that particular trend. So avoiding the wave 2 and the wave 4. So that's of course getting into a bit more detail on how to recognize which phase of the market you are in. If you're able to do that, then you try not to be trapped. Okay, but you can't absolutely avoid that. Okay, but you can at least what do you call that, avoid giving back too much money in that particular by buying the tops, and it doesn't the false breakouts, especially very frustrating. Okay, I do that all the time. I buy false breakouts on the upside and I sell false breakouts on the bottom side. It's unavoidable. Okay, but you just want to avoid that, and there are other filters as well that you can use. Okay, one of them, let me show you. Okay, let me get out of this and show you. One of the indicators I use, okay, say for example here, which is on the chart, is I use this 3 lines. This is called the alligator. Okay, you can plot this alligator in, and if the markets if the markets are inside this alligator, that means the price chart is inside this three lines, then you try to avoid taking breakouts in this line, or you try to you filter it. Okay, you only take breakouts on the short side if it's below the three lines. Okay, or take the long side breakouts only on the above the three lines. Okay, so that's like applying a filter. Okay, applying a filter for it. Okay, so there's no easy answer to it, but you can apply other things to help you filter out so that you don't get caught in those breakouts, the false breakouts. I hope that has answered your question. Okay, it
Yeah.
may require more sessions to do that, and I'll look forward to sharing more sessions on that. Back to you, Shane.
Okay. So yeah, if you want to uh, attend more of the David Low classes, okay, or live webinars, please stay tuned on our webinar series. We still have about 3 sessions that will feature David. So pay attention to our emails. Okay. Now, next question is by Guat Lai. So, where do we take profit or put our stop loss in your ABC setup system?
Okay, excellent question, Godline. Okay, where do we take our profits? Okay, now profits or stop loss. Okay, for the stop loss, let me answer the stop loss first, so it's easier to visualize. Let me take this. Okay, let's take for example this particular chart. This is a 15-minute chart. Okay, where do I put the stop loss? You basically either, let's say for example, it triggers over here, right? So if it trades the B, it's triggered over here, you will sell this region. Okay, so now where is my stop loss? After I put the technical stop loss for the ABC system is you either put it at A or you either put it at C. Okay, depends on your risk appetite. Okay, because of course C is a tighter stop. Okay, and A is a further stop, so you give more room for it to move. So depending on your risk appetite, okay, some people like tighter stops, some people don't like, because you know if you have a tighter stop, you tend to be stopped out more often. Okay, if you have there's no magic formula for that. Okay, okay, if you ask me where would I put a stop, okay, although I love to take risks, I also very conservative. I would put my stop at C. Preferably, my first preferred way is to put my stop at C. So let's take, for example, this particular trade at the 1565. Let's say, for example, you short it at 1565, and C is at 1567. So you have to put a stop probably at 1567.5 or 1568. So 68 to 55. Okay, 68 to 55 is 13 points, right? So if you feel that 13 points is a reasonable stop and it's comfortable for you, then it's a good stop, right? So the other stop is at A, which is what's the high? The A is at 1574. So you put your stop at 1575. So 75 to 60. Oh, just now I made a calculation error. So 60. Sorry, yeah. So 74 to 66, 75 to 65 is 10 points. So that's easy meat for you. But this point was what? This is 68. Okay, 68. This is a very tight stop, sorry. I thought it was 50 something. Okay, so from 65 to 68 is very tight stop. So you say for day trader on FKLI, 3 points may be too tight. Okay, so you may prefer to take a 10-point stop at A. All right. So, but technically, it's either the A plus 1 or the C plus 1, or if you take a short position. What about long position? Let's see whether I have any long positions to show you. Okay, so let's say, for example, if you took a long position over here, okay, the reversal of, okay, we have an A here, you have a B here, you have a C here, okay. So over here, if you take a C stop, it's quite near, okay, 94 to about 81, okay. You can take the A stop over here as well, right? So this is A and C. So up to your risk level, because the A is normally, if you take the A here and it moves below the A, it basically tells you that the whole trend has continued to move down. If this is a trend that is coming on. Okay, so I hope that answered the question for stop loss. As for profit taking, okay, there are two ways to take your profit. Of course, you can wait for the opposite signal over here. Let's say, for example, you bought ABC over here, a here, a B here, a C here, then you bought over here, okay, and then you rode the trend all the way up here, okay. You could have taken some profit over here as well, okay. That depends. If you, let's say, for example, if your risk over here was let's say, for example, ABC, your risk is 90 to 56 is about 34 points. If you say that, okay, I'm risking 34 points or over here, depending on where you go in, and then I want my profit to about maybe 1.5 to 2 times, so I want to have a 60-point profit. Okay, so from here, if you have taken 690 and now this is 747, or even over here 758, you already got 60 points, then you might want to take it. Or else, if it's not a money management profit you took, then you could take that sell signal over here. Okay, this is the sell signal on a chart. Okay, that would be like trying to maximize it. Okay, there are other ways to maximize it, but these are two ideas you can have for profit taking: either a 2 to 1 or 1.5 times to your risk, multiples of your risk, or take a chart ABC on the opposite side of the signal. So Nicholas, I hope I've answered your question on both the stop loss and the profit taking. Back to you, Shane.
Okay, great. So should we avoid trading in a sideways market and wait for a strong trend? So that's from CW.
Okay, CW, thank you for that. Sorry, just now the question was Guat Lai. Thank you, Guat Lai, for that.
Yeah, got line here.
Yeah, Guat Lai, thanks for that. CW, yeah, it's best to try to avoid trading a sideways market because that's where a lot of traders lose money, unless you have mastered. There's a way to do it, of course, to trade the sideways markets. You need to trade those counter trend methods. Okay, and there are counter trend methods that I can share with you. Of course, this session is about trend trading, but generally, most money can be made on the big trends. So the big trends are where the big money is as well. So in terms of sideways, if you know or can easily recognize a sideways market, you can recognize so well that you can actually trade a counter trend trade, then you are actually a very well-rounded trader where you can actually make money. That means you are able to change your strategy from a trend trader strategy to a counter trend sideways trader. Okay, that would be fantastic. That versatility is fantastic. You can do that. Congratulations as well. But if not good in that, then my best advice or my best recommendation would be to trade the trends, and then during the sideways market, play golf or do something for yourself. Hope that answer your question, CW.
Okay. Yeah, the next question is from your experience of using this ABC trades strategy, what is the win rate if it's on compared between lower time frame and higher time frame?
Okay.
Say on FCPO.
I don't have a very specific number on that, okay? Because whilst using this, I realized that in the end, okay, although I am this when it takes a trade, of course, trends when it signals is quite good, but in the end, I found out that the main what do you call that determinant of your success in even trading the ABCs will be the trading psychology, right? I see sometimes those signals clearly in front of my screens, okay, but the trading psychology may be very, very different. Okay, basically what the trading gurus say is you basically trading your last trade. Okay, so your last trade is a loss or multiple strings of loss. You will trade very differently on this particular trend. Although the signals are all the same, the ABC setups are all the same, but your previous trades will color your current trade, whether you go in or not. Okay, so let's say, for example, the market was short and you got and then it went to a sideways and you got like broke out, you buy multiple times and you fail and took a lot losses. The next time the buy signal comes on the ABC, so you tend to think 2 or 3 times, because the last 3 signals you have been stopped out, or there was a false breakout. So I haven't really what do you call that, put it into statistics. I didn't put it into a program, but you can of course try out and back test it. Okay, but my best guesstimate is it's better than 60% if you're willing to take all the trades that comes in. Okay, and most of the trades that doesn't work out is during those consolidation ranges. But as it is, I don't have a very specific what do you call that, number on the part. So whether you're trading hourly charts or daily charts, the impact of the what do you call that, the numbers or the statistics may be quite similar, because the system is basically reading the waves. Okay, but what I see is it gives me an edge about 60 to 70% on the win ratio rate. Okay, but the other most important what do you call that, statistic is the win loss ratio. Okay, so test it for yourself, back test it and see how it works for you. But as I said, the trading psychology is one of the most important determinants, which is, I think, the 4th webinar that we're going to do for this year will be on trading psychology. I hope that answers your question for you.
Yeah.
All right.
So the next question is, if, in the event of bull trend, do you trail your, oh sorry, strong trend, not bull or bear trend? Do you trail your profit, or do you add positions?
Okay. If you see multiple, let's say for example, if you're getting on an early trend, okay, you took a nice reversal, the first trend, okay, and then there's a possibility of adding. You want to add at the beginning of the trend, okay, you don't want to be adding at the end of the trend. Okay, so adding positions depend on how you add. You pyramid up. Let's say for example, you start with explorative early trend. Maybe you trade say 1 lot. Okay, let's say for example you have a capacity for say 5 lots. Okay, so maybe you go in 1 or 2 lots on the first breakout to see how that works. Okay, and if it really does break out and moves, then on the next ABC buy, or the next breakout that you buy, then you will probably go in another 3 lots. Okay, so you have a 2 and a 3, then you have a 5. Okay, depending on the capacity of how many multiple lots you can. So you will or I will actually add in on the early part of the trend. Okay, and the next webinar we are going to talk about the momentum trades as well. So we can also add in with the additional new signals that come in. Okay, but basically that if you have additional new signals, okay, that work together hand in hand, then you have what we call a higher percentage chance, because each of those signals that come after it will be confirming your previous signal. So by being the signal that confirms the previous signal, basically you can add on the second signal. Okay, but I normally don't add on as the market goes. If let's say for example it goes for multiple ABC buys already, on the 3rd or the 4th I won't be adding positions over for those signals. I'll only add positions in the early part of the signal. I hope that answers the question.
Okay, so let's do one last question, which is FCPO is famous for its gap opening. So what are our consideration if you want to hold overnight? This is from Richie.
Okay, so if you are holding overnight, you you are actually open to those risks. I have not been able to find a solution for that. Okay, hopefully Bursa Malaysia finds a solution from that. There has been plans to see whether the palm oil contract can trade longer hours, so you will have less hours being exposed to those moves. Basically, some other global markets are moving, whether it's the soybean or soybean oil, or it could be the crude oil markets that they are moving, that will have a very, very what do you call that, a big move. Okay, now there are certain solutions that are actually available on Bursa, but currently the availability of options, if I will be able to trade an options on the FCPO easily, okay, currently the onboard, the prices shown on the options market for FCPO, there are not many of this liquidity over there which you can use. If ideally, actually, if I want to trade the futures, it's best I trade together with an option, which I can use somewhat like a protective, it's like an insurance. It's also like a stop loss, but it always makes me be able to take all those gaps. Because let's say, for example, you are long a palm oil contract, and then you have a put options to protect your position. Okay, and if next day, for example, some very big news hit the market and the market gaps down, okay, your put option will actually be able to protect your futures position, so you won't lose that much money, or you won't lose much money as well. Okay, because the maximum loss is the price of the put protection that you bought. Okay, so this is getting a bit more technical. That is the ideal situation. Hopefully that the OCPO market on Bursa gets more developed, and there's a lot more liquidity where you can do that. That's the best solution. Okay, the second solution is, of course, if the Bursa market trades longer hours, so that you can at least have the aftermarket hours to be able to do something to your Palma position. But besides that, it's I think I have sort of accepted it's part of life of trading Bursa. But if you are in the trend, okay, if you are in the trend and you're trading the structure of the market, I tend to see that those gaps tend to work for me, or work for my position most of the time, right? So gaps are a bit of a very, very challenging part of trading the FCPO, but it's we'll have to see how to manage it, and hopefully some of these products and the time for Bursa, things will develop and be better. So I hope that answers your question. I don't have
All
a particular
right.
solution for this particular issue.
Thank you,
Shane?
David, for your answer to the Q&A session. So what a very lively Q&A session that we have. So I'm making myself a presenter again. So let me share with you what is our next webinar. So the next webinar is on single stock futures 101. So in the event that you have not heard of single stock futures, on Bursa Malaysia, we also have a single stock futures. Okay, so if you, let's say you want to buy, you don't want to buy Hatta, you don't want to buy Hatta shares, you also don't want to buy Hatta structured warrants, maybe you can consider buy Hatta Lega single stock futures. Okay, so that will give you higher amount of leverage to provide sufficient leverage to you if you are the one that who want to trade with a higher amount of leverage. So in this single stock futures, you will discover how does the single stock future work, and then what are the contract spec and so on. So you have better understanding of how you can use single stock futures in your tradings. So it's happening 3rd of September on Thursday, 8:30 to 10 o'clock. You can register at the link that I've just given in the chat group. So click the link on the chat group to register for our single stock futures 101 session. It will be conducted in English language. All right. Once again, I want to thank all of you for staying until so late, okay, at 10 o'clock to stay with us to join this Let's Learn Futures webinar brought to you by Bursa Malaysia and managed by Lifetime. I want to thank our speaker, David, for sharing your invaluable insight as well as your trading strategy, ABC system with us, so that we'll be able to do the breakout trade and trade according to the rhythm of the market. Thank you, David.
Thank you, everyone.
Yes, and have a pleasant rest of the day. Bye bye. This is Shen Chu signing off.